The recent recession has been painful across the board for corporations, so the risk associated with real estate, downside risk, is much more prominent for chief financial officers. So they're much more hesitant into getting long-term leases, much more hesitant about buying anything, even though there is feedback from businesses that they need to add headcount, they need to add space. Those decisions are being controlled and tempered at a central level, at a very high level within the company. So decisions that were made at a middle level in a corporation are being pulled up to very senior level, CFO level of accountability. So that's where I think those decisions are being made, and those executives are much more conservative. For many companies, this is going to be a post-recession phase. So they're coming out of much shorter lease timeframes. They are switching to slightly longer lease timeframes as they see more stability in the future. They're more centralized, more structured real estate organization with a greater control of their data and transparency into the portfolio, with a better handle of what metrics ought to be and what the benchmark standards are. I think they will be looking to consolidate the footprint to major hubs globally that can support multiple lines of businesses most efficiently. I think that's the big trend, to work across lines of businesses to put in place regional strategies. Corporations have optimized portfolio strategies within a business. I think now they're shifting to regional strategies across multiple businesses to create the best footprint profile for the corporation, and to manage not just the downside risk, which is what they've been focused on historically, but to also now focus on the upside and to provide more innovative end-to-end solutions to internal clients around real estate that not just optimize the front-end rental costs, but also the capital upgrades, as well as the ongoing operating costs as well, to create a more compelling total cost of ownership profile for the company. Heading into the new year, companies will look to more value from their strategic partners as well. In the downturn, one thing corporations have done is to take a hard look at how many suppliers they have, who's supporting them in what regions, and to consolidate those suppliers and convert them into more longer-term strategic partnerships. These partnerships have also come under a lot of economic and margin pressure for these suppliers, but they've resulted in much broader relationships with corporate clients where suppliers can provide transactional services, project management services, and facilities operational services. As we go forward into the new year, the thinking and the expectation that corporate clients may have could shift to seeking new ways of creating more value from real estate. Suppliers will be under pressure, or at least perhaps pressure is not the right word, but customers will have more expectations from suppliers around being more innovative in real estate. They're coming out of a tough downturn. They've cut cost and service level in many areas. Now they'll be thinking about, how do we do things differently? How do we create more value? What are the latest ideas from suppliers? And this is an area that suppliers can really create value for clients. It's an opportunity.